my name is Mike LeGassick, obviously an independent financial advisor I work with Andy. I'm going to explain over these new freedoms coming into place and what's going to be changing and how it's going to affect clients. In the last budget, pensions suddenly became sexy overnight, if you can say such a word. But the new rules coming into place are quite groundbreaking and caught a lot of people by surprise. So basically, what I'm going to do is take you through now what the benefits are, how the death benefits work, what we're now for annuities, and the pitfalls in the tax position on it. So currently the rules that aren't changing is, as soon as you attain the age of 55, an individual is able to access a quarter of their pot, 25% tax-free, and then they can decide what they're going to do with the rest of the money, the 75%. So they either buy an annuity with it, they can do that. They can just take the income and go into take the tax-free cash and go into drawdown, and just definitely income taxable at GAD rates and drawdown. So the rules on that haven't really changed so much. What is coming in though is that after April, then they're still entitled to the first 25% tax-free cash, but there's new flexi drawdown rules coming, which means an individual is now allowed, if they want to draw down their entire pension. So the first 25% is tax-free, the other 75% is added to their income in the year they take it and is taxed accordingly through their tax plans. So the flexibility, the access rules are now, the doors are wide open. I did find out an alarming fact yesterday that they conveniently kept very quietly under the carpet, is I found out yesterday that if a client does go into flexi drawdown and takes their 25% tax-free cash, and then wants to take another substantial lump sum using the flexi drawdown rules, regardless of their tax position, they're going to be charged an emergency 40% tax on that lump sum, and they've got to reclaim it back the following April. Didn't mention that at all in the small print. I spoke to 3 insurance companies yesterday, and they all concurred that is what the rules are saying. So if you've got any clients that are entertaining that, you might want to bring them to the attention that that's not going to be quite as straightforward as they thought. So they're going to be taxed at 40% on anything above the 25. Let's get back to just where we are typically then. So as I said, you can take the first 25% tax-free cash, and then otherwise, currently before April, you can go and buy an annuity, go into drawdown, and those are pretty much the choices that most people would take. If you do go into these new flexi drawdown rules, so you take the 25% tax-free cash, and then you also then take more cash, then that individual is governed by a new limit for new personal pension contributions of 10,000 a year. So if you go to the new flexi access rule, take the tax-free cash, and then you want a further lump sum, that individual can no longer make personal pension contributions in excess of £10,000 a year. They're capped. Now, that's quite a sizable pension contribution admittedly for most people, but currently it's 40,000 a year. It's going to be reduced to 10 if you go down the flexi access rules. If you just take the tax-free cash and do not go in and take any more out from a lump sum point of view, that will not trigger the money purchase annual allowance, and they'll still be able to put £40,000 a year in if they have the funds to do so. By the same token, if they purchase themselves a short-term annuity, same rule applies, they're going to be capped. They will no longer be able to put more than £10,000 a year into a pension. Does that make sense? Yeah, it's a bit convoluted, those little rules. But if you take the tax-free cash and all the lump sums, that limit's going to come in at 10,000. So here is what normally happens then. You've got the 4 options of taking the pension. You get to 55, you take the tax-free cash, some people do, either all of it or some of it. Then you've got this pension fund, what do I do with it? Well, you can go into full withdrawal, the new flexi drawdown rules, subject to the new tax and limits as just explained. Drawdown is still going to be there. So drawdown is not going away, so you can take a limit up to the GAD rates, government actuarial department rates, depending on how old you are. Scheme pension, it's been around a long time. Generally, scheme pension we use for people that are perhaps short life expectancies because they're medically underwritten. So an insurance company would say, fill in this medical questionnaire, doesn't look too good for you. Our actuaries don't think you're going to last 6 years. So we're going to give you this amount of pension, but you might run out of money. So that was a way of getting more pension income via a scheme pension than you could through the drawdown rules. So scheme pension, not used that often, but for people in extremely ill health, it was used. And then you've got the annuity, which is going to be a lot of questions being asked about annuities now, because obviously when the new rules came in, it probably wouldn't have escaped your attention that the insurance company annuity providers, their share price nosedived, because they thought, well, why have an annuity if you can have unfettered access? There still is a market for annuities, there still is. I went to the National Retirement Summit last year, and a lot of product providers, they're becoming extremely innovative in now running around like idiots to try and develop new annuity products that give clients an awful lot more flexibility. Typically with an annuity, you burn your bridges. As soon as you buy that income, that's it, there's no going back. It was done on a cross-subsidy basis. If you died, the pension normally died with you, unless you added spouse benefits on. The more benefits you add to an annuity, the income starts dropping down, because the insurance company think they're going to pay it longer. So annuities now, we believe that annuities now are for people that say single, no dependents, no one to leave it to, want a guaranteed income for life, and that's all they're interested in. Anyone other than that, there's not too many arguments now for buying an annuity, because the death benefits on these new rules will explain why. So that's just a reiteration there. When your funds are uncrystallised funds means you haven't accessed them, and here's the options that you've got. So as I said, this just, again, you get your nest egg at 55, just a graphic to illustrate what I've just said. 25% tax-free you're entitled to, the other 75% is added to income and taxed accordingly, but if you start taking lumps out on the flexi drawdown rules, you're going to be stuck with that £10,000 allowance for further pension contributions. So, post-April then, this is where things all change in a couple of months' time. So there are your options. So what's going to be the tax position on that? How quickly do you want to pay your tax? And I'm going to move on then to the death benefits that have changed dramatically. So if you look on the over there on your left-hand side there, basically 25% tax-free cash, and you're governed by the GAG income rates, based on gilt rates. You can have an allowance of £40,000 a year into a pension. Obviously, it reduced this year. Previous years it was £50,000. The carry-forward rules are still available to people that can take advantage of them. So the revenue will let you look back the previous 3 years, see what you could have put into a pension. Theoretically, if you look back the last 3 years and this year, you can also bring next year's pension input forward. You can, if you have the income, you could put £230,000 into a pension in a very short space of time. Carry forward the last 3 years of 50, this year's 40, next year's 40. But moving on now, the new rules. So basically, as I said, take tax-free cash and no income, you can still put £40,000 a year into a pension if you have the funds to do so. But when you take that income of the flexi drawdown rules, you're governed by the 10. So that's the big changer on the funding situation. The annual allowance doesn't change, it's still £1.25 million. Nice if you've got it. I don't know too many people who've got £1.25 million pension funds, but I'm sure there's a few around. Now this is one of the big ones. This really did catch a lot of people by surprise. The death benefits post-April have posed us an incredible amount of questions and inquiries. This has really made people sit up and think, well, hang on a minute, how does this affect me? And we've had people with final salary pensions been on the phone to us, and I'll tell you a little bit about that in a moment. Final salary pensions, holy grail of pensions. You wouldn't touch them with a barge pole. An income guaranteed for life, index linked as well. Apparently, no worry about investment performance, funds can't go down. Final salary pension schemes, they're obviously a dying breed, but there's still a few around. They're still fantastic schemes, but the death benefits have never been so great. Because if you're in a final salary pension scheme and you die, then what would normally happen is if you've got a spouse or a dependent, they may get 50% of your pension, but then when they die, it dies, the pension's gone. That's the downside. So if you get a crystal ball, it'd be great, because if you knew you were going to live to be a ripe old age, you'd be quids-in on a final salary. But what happens if you were to die earlier? Well, these new pension rules now mean that if you take your pension post-April, you're a personal pension holder, and you die before 75, your spouse or your dependent will inherit the entire pension fund tax-free. No tax at all. It stays under your roof. That is pretty incredible if you think about it. Not only that, but it goes on, and it goes on, and it goes on. So, I die before 75, my wife gets the pension. If she dies, she can give it to someone else. If they die, they can give it to someone else. Tax-free, 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 tax-free until all the money's gone. That's providing you die before 75. What happens if you die after 75? If you die after 75, it's still not bad, to be honest with you. Currently, now, as we speak, as of today, if somebody dies in a pension, personal pension, the survivor's got three options to choose from. They can either go and buy an annuity in their own right with the money that's left. They can go into income drawdown, as their spouse was, and take an income that way. Or they can go off and save the elephants to Africa, cash the whole pension in, and the revenue are charged on 55%, which is pretty steep. Now, with the new rules coming in April, if you die after 75, then you can still go off and save the elephants in Africa, but they're going to hit you with a 45% tax charge, not 55. But if it stays within the pension, and your beneficiary just wants to take income, they only pay tax at their own marginal rate. So if you die before 75, keep it in the pension, they can just draw it all out tax-free, or just keep it taking income from it and no tax to pay. Or, as I said, if you die after 75, they can still access the pension, but the recipient only pays tax at their own marginal rate. Now, we've had a lot of inquiries. I spoke to the pension transfer department from the NHS and the teachers scheme, and we can see a bit of a dog's dinner appearing before our very eyes, because the government are proposing to put a ban on transferring out unfunded public sector schemes, so your armed forces, emergency services, NHS, teachers. There is a ban proposed that on the 5th of April, you will be unable to transfer out of an unfunded public sector final salary scheme. And when I spoke to them yesterday, they said they are currently inundated with requests on what would my pension be worth if I was to move it from you and put it into a personal pension because of all these new rules, these access rules. The death benefit ones are the main driver, in my experience. They want to know that if they die, their pension goes right through to the family. Now, when I spoke to them, they're telling their employees it takes them 3 months to calculate how much that pension's worth. Because if you were to move your pension from a final salary scheme, the people that run the scheme have got to do what's known as an actuarial calculation. They just say, look, what's your benefits worth? Well, we looked at your package, we think it's worth 400 grand. So if you wanted to move it to an insurance company, that's what we're going to write a cheque out for. Do you want us to transfer it to an insurance company because you want to take advantage of all the rules? Well, they're saying it's taken 3 months to get those figures. That's going to take them way past April. So what happens to all the people that have been sending off their letters 3 months ago and still haven't got their figures, in April's looming? Well, I asked them, and they come back and said, tough, basically, was what I got back. So due to their systems taking so long, if they don't get all the paperwork from an individual that would, for whatever reason, want to make it move it away from the final salary scheme, he would not do that lightly. If they don't get all the paperwork in before April the 5th, it's not going to happen. And they can't get the paperwork in until they send the figures to the client. It's a bit of a chicken and egg situation. The NHS, believe it or not, I've got a client at the moment who's going through a divorce and absolutely must, she's got to, for one reason or another, but she needs to take a pension out of the scheme to get hands on cash. They've said the only way we can give you an accurate cash equivalent transfer value is you've got to be a deferred member, so you're going to have to get yourself out of the scheme first before we can do that. Absolutely crazy. So she's had to fill in an SD 510 form to get herself out of the NHS pension scheme, so they then can give her the figures that she needs, and if she doesn't decide to do it, she's got to get herself back in the scheme again. I think it's going to be a nightmare in a minute. It's going to be complaints hand over fist. What about me? What about me? You didn't get my paperwork back. I think what a fairer system would have been is if the government had said, if you can demonstrate that you've gone down the road, you've started the wheels turning, we'll honour if you want to move out of that scheme. The teachers said they've had no firm directive. They said, well, it's business as usual for us at the moment. We haven't, nothing in our department says we cannot do transfers after the 5th of April. So it's a case of watch this space. But the benefits taken of today is when you speak to your clients, pension planning, they really need to think now long and hard about what they want to do with that pot of money. They really need to think long and hard, because the benefits of handing it down through the family, ill health, reduced life expectancy, you know, they really need to think, because these death benefits now are the most important thing, and this is the thing that people are really, really taking a close look at and asking questions about. They love the fact they can hand it down through the family.
What's the problem with the deadline?
Well, this is unfunded public sector schemes. If you're in a final salary scheme with anyone that's not, but there's a funded scheme, no problem. You can transfer at any time. But because they're unfunded public sector schemes, the government don't want them taking out millions and millions out of these unfunded schemes. So they're saying we can't do it. We're going to put up a lid on it. They're the ones who are going to put a ban on. And then the third thing is, what happens if it gets taken to the European Court? Well, I'm being financially compromised. All these can take their money out. I can't get my money out. That's my money in there. I want to get my money out. So where it's going to go, we really don't know. But it's going to be an interesting thing to see. But you get the main gist of that as far as the tax position. Any questions on that at all? So this comes in April. These are the two big game changers. They're the ones that are coming in April. The last thing I'll finish on is, are any of you involved in the SAS market, small self-administered scheme, specialist pensions market? If you are, it's not commonly known that these schemes can be written on a final salary basis. Been around for years. If you've got the right clients in this type of position, if you've got clients that can benefit from what I'm about to show you, you will have a client and a friend for life, I can assure you of that. So a small self-administered scheme, basically, it's priced as a final salary scheme. So what it is, all it means is that company directors go to an insurance company and they will actuarially calculate how much a client's got to put into a pension to get a given level of benefit in the future. Much like a final salary, it's predetermined. But the thing is, they don't have to take the benefits as a final salary scheme. They don't have to. This is all about a funding exercise. And as you can see, it isn't based on multiples of, depend on gender, age, marital status, or expected retirement. It's got nothing to do with that. They just look and say, how much of a final salary do you want? And they make it as expensive as possible. They add things on like spouses benefits, they add indexation to make the premium as high as possible. So the client can make a huge pension contribution. It basically is not linked to the £40,000 a year annual allowance, annual contribution. And this is what we did for a couple of clients. We did this just a couple of months ago. It was calculated that these two company directors who are 60, they could put in £800,000 into a pension. That's what the premium was. They own their own business. They've got a garage which is worth £200,000 that they work out of. There's no mortgage on it. And they, luckily enough, they had a lot of cash. They had £600,000 in cash in investments and bits and pieces. So what they've done is they've put £600,000 of their cash in, and they've transferred their commercial property in specie as a contribution into the pension. So the property is worth 200, the cash is 600, so they've got £800,000 into a pension. And obviously they're entitled to 20% corporation tax relief. Our client's corporation tax bill is about £25,000 a year. They're probably going to keep the business running for about another 5 or 6 years before they wind it up. So they're not going to have a corporation tax bill now until they retire. They won't have one anymore because they're entitled to £160,000 in corporation tax relief on that 20% of the 800,000. So bizarre, but imagine not having to have a tax bill for 5 years. And of course, because we've taken it out of assets that would have been taxable from an inheritance tax, because these guys have got a big inheritance tax problem, we've now moved that £800,000 out of an inheritance tax sort of area into the pension, which is free of inheritance tax. So 40%, they also save £320,000 in inheritance tax, or their beneficiaries will. So by making that type of contribution, we've saved them not far short of £500,000 in tax that otherwise would have been paid. Now, you may not all have clients like this, and the figures don't have to be as big as this, but you really want to earmark this, because if you've got any clients that you feel own their own commercial property, they don't have to own it outright. You're able to put the equity within a commercial property into a pension vehicle. The benefit being, obviously, is if it's within a pension, when the property is sold, there's no corporation gain tax on it. If it's held outside, it would be. So this type of planning, all I would say is, it's a specialist area, it's nothing new, it's been around for years, but it's not that well known. If you've got any clients that you feel that would want a presentation to see, is this viable for me? What's in it for me? Everyone's favourite radio station, WIFM. If you've got anyone there that says, could this work for me, and how does it work, what's the features and the benefits, and obviously we'd be delighted to have a chat with them, and then we can quickly ascertain whether they could take advantage of these types of schemes. So pensions, they're very versatile vehicles these days. There's a lot of options out there. It's just educating people so they can make a fully informed choice. You've got all these assets kicking around, which is the most tax efficient way of utilising them to get an income in retirement. So thanks ever so much for listening today. I know it's been a pretty heavy session. Pensions are not the most exciting subject. You can't really make them exciting because they're not. But if you've got any questions or queries or want to revisit this, then please do let me know. Anything at all initially about the new rules?
One point, just to add to the new rule thing, is that the Australians opened up their pension system, freedomised it, for its better expression, a number of years ago. I don't know lots of detail about their experience on it, but the Australian government are now looking at re-annuitisation. Because I guess some people have got carried away with the freedom and spent it on things they maybe shouldn't have spent it on. So what does that mean for us? Well, we don't know how long this open access policy will last. Of course we don't. It could be here forever. It might not be, depending on experience. And possible future changes of government. We've got an election coming up, haven't we? So there could be another change to this. One person mentioned, well, it could be, somebody could be disadvantaged. They're thinking, okay, I'm going to be 55 in 3 years' time, that's great, I've got all this access, and they make plans for it, and then by the time, in between age 51 or 2 and age 55, suddenly there's a change of policy and they can't access it. Huge frustration.
If you look at pensions as a whole, there's a massive problem. People are saving enough for retirement. We all know that. Very, very few people are. The retirement summit I went to last year, one of the guys who spoke as an actuary. Try not to sit next to an actuary if you get a chance. You can always spot them because they're the one that are looking at your shoes when you're sat down at a table. Right? But they know the stuff. And they come out with a really interesting fact. Now, you might boo-hoo it, a lot of people chuckled at it, but these guys do a lot of research in this area, and they made it public that they said, as of today, this is going to sound crazy, but they've done a lot of research into this, they said, as of today, we believe it is not beyond the realms of possibility that there's little Billy or Julie walking around at the moment who could conceivably live to be 150 years old. Now, that's a very bold statement. Everyone laughed and scoffed, and they said, well, before you get on your high horses, just listen. They said, you have to see where medicine and stem cell technology is going. Where it's come in the last 20 years, where will it be in 80 years' time? You can go in and have a heart replacement, perhaps in a lunch hour. It's bizarre, but these are the way things are going. Body part replacement. Don't want to get into the gold thing or whatever, but all they're saying is they're talking in science terms. Now, 150 may be a bit of a, but they believe that's not beyond the realms of possibility. They spoke to the scientists. But it certainly won't be beyond the possibility of living to, say, 110. That is quite acceptable. If you think about it, we live in an environment where people desire to retire early, but we are living longer. So if you wanted to get out at 55, imagine having to have a pension that's going to last you 55 years. It's a real problem, and they are scrambling to find a solution to this. At the end of the day, we're going to be working longer. That's as simple as that. But when you're 70, it'll be like being 50 today. But however way you cut it all, there's a major problem the government are trying to get to grips with. And the insurance companies and the actuaries are working feverishly to come up with ideas and solutions, but nobody's quite cracked it yet. But it's a problem, it's not going to go away. Thanks ever so much for listening. Really appreciate your time, thank you.